What I said last time I was on this program, most of the U.S. financials, probably all of them, are already worthless. There is no value whatsoever in the common stock of Citi or even Bank of America. All the value now rests in the preferred share that the government is accumulating. And every time these companies announce more and more losses and they get a bailout, the bailout isn't free. The government gets more preferred stock. So at the end of the day, there is no value in the common. Anybody who's buying stock in any of these financials, they might as well flush their money down the toilet.
Peter Schiff of Euro Pacific Capital and our own Bob Pisani. Good to see everybody. Thanks for joining us. Peter Schiff, let me kick it off with you and get your take on what's going on in Cyprus right now. What's the impact?
Well, a lot of people are hoping that what happens in Cyprus stays in Cyprus, but, I wouldn't be so sure. I think bank depositors, including depositors here in the United States, have to be concerned about the value of their deposits, because if we have a major bank failure in the United States, there's no way the FDIC has the money to cover the potential losses, and so we would have to have a huge bailout like TARP. And where would the money come from? And even if there is a bailout and the Fed has to print money, the losses to depositors through inflation will be far greater than what the Cyprus depositors are losing due to this tax.
Hank Smith, it is pretty extraordinary that that the depositors would have to pay for a bailout that they didn't even necessarily authorize. What do you think about what Peter said? Is this a recipe that would be used elsewhere in the world?
Oh, I highly doubt it, Maria. Look, and I think we should take great confidence in our banking system now compared to where we were 4 or 5 years ago. Our banks are very healthy. TARP was a good thing. It protected the financial system and the confidence in the financial system. And our banks are in great shape, earning their way out of...
They're in the worst shape they've ever been.
No.
If they're a few interest rate hikes away from insolvency. That's why the Fed is keeping rates at zero.
Wait a second. Peter, you're saying that the banks are a couple of interest rate points away from insolvency?
Why do you think when the Fed did the stress tests, they didn't ask the banks to stress test a collapse in the bond market? They only looked at the stock market or maybe real estate. But when interest rates rise substantially, the major banks are going to fail. Their balance sheets are not going to be able to handle it.
And how do you explain the billions plus in profit that JP Morgan made last year? How do you explain the capital levels on the balance sheets of all these banks that are way above even Tier 1 capital, which is the Basel regulation?
Maria, they're speculating with cheap money. When the cheap money goes away, the losses are going to be there. They're going to be enormous. What do you think is going to happen to these bond portfolios, these portfolios of real estate loans? What's going to happen when the Fed finally takes the punch bowl away and lets interest rates go up? And it's not only the banks. The U.S. government can't pay interest on the debt when the rates go up.
Now, look.
Maria.
Yes.
Hi, Maria. This is Jason Prida. I don't really agree with what your other guest here is saying. The banks have greatly improved their financial condition. Yes, it's cheap money, but the cheap money's here. It's going to be here for quite some time. What I do agree with him is the Cyprus issue is something to watch. This is an example of policy mistake. We are still in a period of deleveraging. Policy mistakes can happen. Spain itself has to refinance 20% of their GDP in new debt issue this year. That's a lot of money to actually have to issue to the markets, and there are more than enough opportunities for missteps by policymakers, which is what we're seeing the reaction to today in the markets.
Remember, their first mistake, though, is to even insure the deposits in the first place. That's a big problem. Government should not insure bank deposits. That's a tremendous moral hazard. That is one of the main reasons that the banks make reckless loans, because the depositors don't care what the banks do with their money because the government's there.
That's one of the guardrails to oversee these banks.
But we don't need it. We didn't always have it, and there are other nations that don't have any deposit insurance, and their banking system is much sounder than ours.
Right, and they're asking depositors to pay for the bailout.
No. There are no bailouts in those countries. The countries that don't have deposit insurance have a healthier banking system. Because we have this deposit insurance, American depositors don't care how reckless their banks are. And the banks don't care because the depositors don't care. So it's a terrible system, and eventually it's going to implode. And people who have money on deposit in U.S. banks are going to take huge losses one way or another. Either they're going to lose their deposits, or their deposits are going to lose value because of all the inflation that's going to have to be created to bail out the banks.
It's been a pretty good fourth quarter for the big US banks. JP Morgan Chase was the first out of the traps on Thursday, announcing a record $24 billion of profit. thanks to a slight increase in revenues and a big focus on costs. Next on Friday was Citigroup with another very good year. And then Wells Fargo also pushed past Citigroup to rank as the #3 bank now by assets in the US, thanks to strong growth in credit cards, in mortgages and car loans.